I know you deal a lot with residential, but how's the investment world? Are there a lot of fix and flippers up there? Are there a lot of, I guess more on the commercial side, like real estate investors? What does that look like up in Detroit?
It's very difficult to find the fix and flips because there's a lot of people who got into that game, but there's
Mm-hmm.
not enough inventory for it. I mean, there's not enough inventory in general, but there's just not enough inventory for most people. I wish it was easier because I know many people would be in it. But the fact of the matter is right now the margins are so thin. You really have to be a professional and know what you're doing. Otherwise, you're going to lose money. Now, I was telling somebody the other day they were going to do this, and I said, what you might want to consider is a hybrid. Buy a property that doesn't need anything crazy, put some
Mm-hmm.
money into it, increase the value of the property a little bit, refinance not all of your money out of it, but a lot of your money out of it. And now you have a lot less in it. So your cash on cash returns a little bit better. You can't sell it as a profit. It won't be completely positive. But by doing this, you can have less total funds in it. And then your previously was a maybe negative return on investment is positive. And that allows you to actually get properties under contract because the big problem is that there's just not the properties. So you got to
Mm-hmm.
think outside the box. I mean,
Yeah.
if you want to invest, you got to think outside the box.
This episode is brought to you by Pierre Tax and Accounting, led by CPA Eric Pierre, a seasoned accounting and tax expert with years of experience helping individuals and businesses navigate complex financial landscapes. Whether you need personal tax planning, business tax strategy, bookkeeping, or financial planning support, Eric and his team are committed to helping you protect and grow your financial future with clarity and confidence. To get expert guidance you can trust, check out Pierre Tax and Accounting at pierreaccounting.com. This episode is brought to you by my friend Silas Lagoy over at ForgeMark Wealth. If you're a high-income business owner or professional and feel like you're getting crushed by taxes, you're not alone. And more importantly, you're not stuck. ForgeMark Wealth specializes in advanced legal tax strategies and wealth planning designed to help you keep more of what you make, grow it efficiently, and actually build long-term freedom, not just income. If you're making serious money but don't have a real strategy behind it yet, I highly recommend connecting with Silas and his team.
Hey guys, welcome back to another episode of the Builder's Bible podcast. Today, we're going to be covering a lot of key topics, the challenges, the pain points, growth, expansion, and many more. So stay tuned. I hope you enjoy it.
Nick, I appreciate your time. Thanks for hopping on a call. How are things up north?
Yeah, well, they're good. Everyone's just waiting for spring to be over.
Yeah. We've kind of had spring here in Denver pretty much since fall ended. So yeah, not much of a winter here.
Nice.
Yeah.
Wow. Our winter was vicious.
Yep. Unfortunately everybody but Denver essentially, got hit pretty hard. Or usually that's not the case, but
There's still piles of like dirty snow everywhere. Yeah. People are done.
yeah, I get it. So, but yeah, let's get started. Give me a little bit of background. Tell me how'd you get into real estate? You've been in real estate for, what was it, 16 years, if I remember correctly, since our last conversation, and been doing it ever since.
Yep. So, basically, I was actually selling mortgages at the time, and this was back when the mortgage world was falling around me, and I didn't realize it. I was with a company that had 7 locations, and then I got downsized into one of the other locations, and they had 6. Then they had 5 locations. Then they had 4. Then they had 3. And then they had 2. Then they had 1, headquarters. And then the headquarters was like 3 stories of this building, and then they got rid of a story. So they were only 2 stories. And at the time, I just couldn't see the bigger picture. I was like, I was like, oh man, I'm doing really good. I'm making it when all these other people aren't. When in actuality, it was just like, a falling knife, and I hadn't been cut yet.
Yeah.
Because it was just a matter of time. The world around us back in 2008 and 9 was just, falling.
Yeah.
And so eventually I got cut too,
Mm-hmm.
and that company no longer exists, of course. And then I went and just talked to a few people I'd been doing business with. One of them was a real estate agent, and he's like, "Why don't you come on this side of the table, see if you like it?" And I went over there and just kind of never looked back. There's so much versatility you can do on this side of the table. It really intrigued me, and I loved it. So kept doing it.
Yeah.
Put my head down and just learned a lot of aspects of this side of the business.
Sure, absolutely. I'm sure the ups and the downs, and I'm sure the craze, about 10 years ago when rates were 2-3%, people were just buying and selling like crazy. I know I did.
Yeah.
Sure, no, that was probably 5 or 6 years ago. Yeah, sorry, not 10 years ago. Yeah, I know I did. Luckily, I was able to get in my house prior to that and then sell it and move. But yeah.
What's up, everybody? This episode is sponsored by ExitWise. If you're a business owner thinking about selling your company, whether that's now or years down the road, you need to know what your business is actually worth and how to maximize that exit. That's exactly what ExitWise does. They help you prepare, position, and ultimately sell your business by assembling a world-class team of M&A experts around you, guiding you from valuation all the way through closing. If you want to know what your business is really worth and how to increase that number before you sell, go check out exitwise.com and get ahead of it.
Actually, yeah, talk to me a little bit about that. How was your experience with that whole trade?
Well, there was a time when
Nick,
people
are you
don't
there?
remember this now. Yeah, can you hear me? Can you hear me?
Yep, you were breaking up for a minute. You're back though.
Oh, okay. There was a time when literally every house, if you went to sell it, it might take a year and a half to sell it, and there was nothing wrong with it. There were just no buyers.
Right.
And you would, if there was a showing, you would go over there and you would like stage the house for that showing. I mean, it was a big deal. And and there was a time, I'm Metro Detroit, and we were one of the hardest hit areas around. I mean, there was properties that lost in some areas 80% of their value.
Wow.
So there were people left and right leaving properties that maybe they could afford still, but they just didn't want to deal with it, and they didn't want to be paying on this house that was worth 20 and they owed 100. And so many people walked away from properties, and there was a 1 year we did I want to say 95% of our business was bank owns. There was another year that 95% of our business was short sales, meaning people were selling it for less than what they owed on it. I'm sorry, for more than what they owed on it, and the mortgage was like maybe $100,000, and they owed, $105,000,
Mm-hmm.
and they were selling it for 20,
Gee, wow.
and they couldn't sell it for 20 because they didn't have $80,000 to bring to the table, but maybe they needed to move out of state for a job, or maybe somebody died or got sick or whatever. And so the bank would agree to this after 6-9 months, a year, or whatever of, it was a crazy time, because you'd sell a house, but maybe you wouldn't close on it for a year. Like, you really didn't know when you were going to be closing on it. So people weren't locking loans. It was, people would make multiple offers. We had buyers that would be under contract with like 3 or 4 homes, because you never knew if a bank was going to sign off on it. It was just a really different time. And then, the market turned, and property values started to increase, and interest rates were at historic lows for a long time, and then you couldn't keep a house on the market.
Yeah.
You know, you'd list a house for sale, and if you were a buyer, you had to pay 50 over, and you had to give up the name of your firstborn child. You know, and it was a complete opposite. You know, a seller couldn't do anything wrong. You know, why would you put a roof on it? Somebody will buy it with the old roof.
Mhm.
You know, and so it really, the market, you know, it goes through these stages, and you know, people forget, like, or they have recency bias, you know, but the market's always moving. It's very dynamic, and it's important to keep that in mind. Like, you know, it's all supply and demand.
Yep. Yep. Absolutely. It's funny. It's to that point, my dad, he would always tell me how much his first condo was. He's in California, here in Denver. I can't remember, back in the '80s, and it was like $90,000. But his interest rate was like 18 or 20%, something ridiculous like that. So it's
Yeah.
and funny, like looking at rates now and just being, just based on my experience, my 35 years, 36 years of experience, like I couldn't even imagine 18% interest rate. Like 6, 7% is pretty high for us, and we've seen 2 to 3, and I was like, wow, that's crazy. So yeah, it's funny. I
Yeah.
always think about that too. We're like, oh, rates are it's too high, and when I'm just talking to people, I'm like, well, it's been worse.
Yeah. Yeah. The older generation, if you talk to them, like your dad's age or my dad's age, you know, those baby boomers, most of them had 7, 8, 9, or if they bought a house in the, you know, early 80s, late, you know, they experienced that, you know, nearly 20% interest rate. And I tell people the alternative is very simple. You know, write a check for it, you know. And most people say, well, I can't write a check for it. And I say, well, that's the exact thing. I mean, you're able to borrow 90, 95%, 80%, 99%, whatever the number is, the value of these homes, they get to dictate it, you
Hmm.
know? And it's crazy. But yeah, I mean, this is a roller coaster.
Yeah.
And it's a long game, too. Like, you know, those people in 19%, they didn't stay in them forever. You know, when interest rates became 10, they refinanced most of them,
Yep.
you know? And same thing here. You know, if people were in an interest rate of 7.5 or 8, they might have already refinanced, you know, because we're, you know, back in the sixes now.
Yep.
It's a game.
This episode is brought to you by 10x Nerds. If you're a business owner doing real revenue, there's a good chance you're overpaying in areas you haven't even looked at. Things like credit card processing, insurance, telecom, and more. 10x Nerds comes in, audits your expenses across 30 plus categories, and finds immediate savings. And here's the kicker: they only get paid if they save you money. It's a complete no-brainer. If you want to keep more of what you make, go check them out at 10xnerds.com. This episode is brought to you by Rakowski Law Firm. If you're a business owner or have built a level of wealth, but you don't have your estate plan dialed in, you're exposed. Rakowski Law Firm helps families and business owners protect their assets, avoid probate, and make sure everything transfers exactly how it should. This isn't just paperwork, it's a real strategy to protect your legacy. If you haven't looked at your plan in a while or don't have one, go to rakowskilawfirm.com.
Now, correct me if I'm wrong, but I saw some banks are doing like 4.5% financing, under certain conditions for like the first 3 or 4 years, and then, of course, it's going to increase to whatever the market's going to be, after that time. But is that something you're seeing as well too?
Oh, yeah. So there's a couple of products that are popular right now. And one of these is, you know, typically been popular for a long time. And that's called an adjustable rate mortgage.
Hmm.
And that short term name for it is an ARM.
Yep.
And what happens is your interest rate is actually lower than what a normal 30-year fixed rate would be. People don't realize on a 30-year fixed note, you're paying to lock in that rate for a long period of time. You're paying to lock in that debt. But if you don't need that debt for that long, the ARM adjusts after a certain period of time. It could be 3 years, could be 5 years, could be 7 years, whatever the case may be. They have a bunch of different products. And so if you're going to be in your home for a little bit shorter time frame, or you know something in your life is changing, i.e. your wife is in school and she's going to have a job after this, so you know you're your life, is changing, or in 2 years you're going to get married and have kids, or in 3 years, you're going to relocate because of your job, you might want to consider one of these programs.
Mm-hmm.
The other, because an extra little bit of a percent or 1.5% off in interest rate savings is just a multiplier of how much you can save, depending on how much your mortgage is for. If you got $1 million mortgage, it's going to be a much bigger savings for you. If you got $100,000 savings or mortgage, it's not going to be as big.
Mm-hmm.
The other product, what we have these kind of prepaid loan buy downs, interest rate buy downs, okay?
Yep.
And what happens is they're basically front loading the cost. And a lot of times you see these very often with builders, because builders will take it out of their proceeds. That way they're able to keep their cost high. The comps are still high because, the initial cost for these houses is the same. They just take it off the top and they prepay whatever it is, a percent or whatnot, to the mortgage company. And they say, all right, for the first year or first 2 years or first 3 years, we will subsidize the interest rate by prepaying that right now.
Oh.
And in that way, you can take a 6% down to I actually saw another one of the agents that's in one of my networking groups, and she deals in Texas. They had one that was, the first year was 0.99, the second year was 1.99, the third year was 2.99, and then for the life of the loan it was 3.99. I mean, incredible. It's all prepaid, but I mean, those are some of the incentives that are sometimes out there. Here in Metro Detroit, I haven't seen anything near that, but you could potentially get like in the fours to start, which is great. Like 4.01, I've seen 4.25. I have not seen in the threes, but I wouldn't be surprised if interest rates dropped another quarter or a half if I saw introductory rates in the threes.
Sure.
And then your long-term rate is in the sixes, but again, that's 2 or 3 years of savings. In 3 years, you might be making 20% more, so that can be very helpful to people.
Right. Nick, I actually just thought of a second job for you. You should start a lending company, since you have that background, to offer what they're offering in Texas and Detroit.
It's crazy. I'm not sure how some of that stuff is paid out on the back end, because it's kind of incredible, but I mean, somebody's making money.
Yeah. I mean, someone's making money. Absolutely, nobody's in it to lose money, especially builders too, because they still got houses they got to build, and they still need to that cash flow to keep
exactly.
Yeah. Well, talk to me a little bit. How's the? I got a question. How's the? I know you deal a lot with residential, but how's the investment world? Are there a lot of fix and flippers up there? Are there a lot of I guess more on the commercial side, like real estate investors? What does that look like up in Detroit?
It's very difficult to find the fix and flips, because there's a lot of people who got into that game, but there's not enough inventory for it. I mean, there's not enough inventory in general, but there's just not enough inventory for most people. And so it's a very difficult game to be in. I wish it was easier, because I know many people would be in it. But the fact of the matter is right now the margins are so thin, so thin. You really have to be a professional and know what you're doing. Otherwise, you're going to lose money. Now, I was telling somebody the other day they were going to do this, and I said, what you might want to consider is a hybrid. Buy a property that doesn't need anything crazy, put some money into it, increase the value of the property a little bit, refinance not all of your money out of it, but a lot of your money out of it. And now you have a lot less in it, so your cash on cash returns a little bit better. You can't sell it as a profit. It won't it won't be completely positive, but by doing this, you can have less total funds in it. And then your what previously was a maybe negative return on investment is positive. And that allows you to actually get properties under contract. Because the big problem is that there's just not the properties. So you got to
Hmm.
think outside the box. I mean,
Yeah.
if you want to invest, you got to think outside the box.
Right. 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 Yeah. No, that's definitely a good. That's actually really creative. Definitely. Because I'm just thinking, like, you think of fix and flippers, they go in, remodel a house, then flip it, 6 months later or whatever. And then, so
Hmm.
absolutely, to your point, doing something creative, kind of like the hybrid model that, yeah, you just, suggested that's a great idea for, someone to looking into getting into that market, in your area.
At least then they can have something where they're actually controlling the asset. The other
Yeah.
thing, and I just talked to a client about this, is people right now have more equity statistically than they've ever had before.
Really interesting.
Yeah. Yep. So here's a thought. You own a property, it's worth $100,000 more than what it was before. So if you
Mm-hmm.
sell it, you could put that 100,000 in the bank or you could put it down towards your next property.
Mm-hmm.
Another thought is you could do a home equity line of credit on it. You could take out 80% of that money. Okay.
Mm-hmm.
So now you take $80,000 out of it. Use half of that to for your down payment on your next property, 40,000, which you can buy your primary residence for 5% down conventionally, especially if you're a beginning investor. Take half of that, put it in the bank, 40,000, you have a rainy day fund because you're going to be buying a new house and you're going to have an investment property. So now you
Mm-hmm.
got your rainy day fund. You already own the property that you're in, so the taxes are capped, so there's advantages to taking that property you already own and then take the $40,000 from the equity, go buy your next property, right? And then keep the original one.
Mm-hmm.
Now you've kept the original property and you've doubled the assets that you're controlling.
Mm-hmm.
So this allows you to get into the rental game without fighting somebody over that rental. And you're keeping a property where you know everything about. Now,
Mm-hmm.
I wouldn't recommend this if you know your primary residence is going to need, some major mechanical or structural thing, and big expenses coming up. But if you've already done a lot of the things that are structural and mechanical, and you know that your house is, would is in a good area and would rent out, this is a great idea.
Sure, sure, absolutely. Are you seeing? I mean, you were just talking to a client about that, but have you seen that in the past? People doing that, or
Boy,
is there a lot of that
it,
going on?
I'll tell you what, it's a long-term thinking. And
Mm-hmm.
I see very few people like to do things with long term thinking. They see the here and now.
Yep.
I've seen it here and there. And I try to tell people if you can keep real estate, it's great.
Yeah.
30 years from now, you're going to be happy you kept this versus taking it off the table. But
Sure.
it's really hard for people to see that. Um,
Yeah.
you know,
Mhm.
so I can't force people to do it. It might be a little uncomfortable right now because you're doing something that, your neighbor's not doing or, it's just not common. But man, if you can keep assets, real estate long term is really good.
Oh yeah, absolutely, absolutely. Just even here in Colorado, like I live kind of in between downtown Denver and the airport. If you're familiar with Colorado, the airport's way out east.
Okay.
And it used to be in the middle of nowhere, but now,
Okay.
like, as time goes on, things are developing, they're filling in, and everything is moving out east because we can't go west because we have the mountains there.
Mm-hmm.
The only way you can go is out east, north, and south, and that's pretty much it. And even south is actually getting kind of capped as well too because you're getting into the mountains and a lot of the small towns there. Like my dad, he lives in a town called Castle Rock, and they cap the residential builds, in Castle Rock. So
Yeah.
after I don't think it's coming up after a certain amount of houses that are being built there, the mayor said we're not going to allow any more building down here because they want to keep it a small town. So it really is like at some point it's just going to be east and north. So
Yeah.
yeah,
Yeah. I mean, that's great for long term prospect. Short
right,
term, it kind of sucks because if you have a house that's like 3 years old, somebody might not buy your house because they'd rather buy a new build. But
Yeah.
long term, if that area is being built up, there's going to be more restaurants, there's going to be more shops, there's going to be more of all the other services that are needed as time goes on. So business is going to create more business, and people are going to need places to live. And with the hub there and the air, yeah, I agree 100%. Everything you're
Yeah.
saying.
Yeah. 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 It's funny how, time tells everything. I always kind of tell, people that it's, just give it time. Just give it time. Whether good times, bad times, you're trying to figure something out, just give it time. It'll come.
Do you know who Brandon Turner is?
I haven't heard that name, no.
So Brandon Turner is like he's well known in the real estate investment world. He used
Okay.
to be the main host of a podcast called Bigger Pockets, which was the largest real estate podcast in the world for, I think it still is, but it
Oh,
had
wow.
been for like 10 years in a row because they kind of started before other people were in the game.
Okay.
And so he was the host there for many, many years. And he has this video that came out last week that I just saw, and he said the real game is to make your properties cash flow enough that you can keep them long enough for the appreciation to happen, because you
Mm,
don't know when that appreciation is going to happen. One year it might be up 20%, the next year it might be down 3%. But then when you look at this over a long period of time, all of a sudden my property that was worth X is worth X times 4. And we're talking about big numbers because that's 100,000 or 200,000 or 300,000 times 4. Now my 300,000 is worth $1 million, and I put $10,000 down to buy that. It's
yeah.
hard to own. I got to manage it the right way, but the real goal is to buy these assets so that they cash flow enough that you can hold them long
Mm,
enough to realize those gains.
mm.
It's a long game, unless you're flipping, but otherwise, it's a long game.
Yeah, yeah, absolutely. I completely agree. Real estate it is a long game. It's hard to make a quick buck in the real estate world, especially if you're fix and flip or like, oh, I think I found a little diamond in the rough here. I can flip this real fast. But yeah,
Yeah, and when I'm helping sellers and buyers, I tell them that too. I mean, I sit them down and I say, look, think about this. Don't think about like right this second. Think about like over time. Here's what this place is going to cost. Is it going to make you broke over,
mhm,
over the course of the year? Or does that feel like a budget that you can handle? And it's always something that says, yeah, I can afford to fix this up to sell it for top dollar, or I have to sell it right now as is, or yeah, like Nick, this is well within our budget. We budgeted the extra 1,000 that you're talking about for all the other stuff that we're going to need. It's really about looking at it as a whole and saying, is this in my wheelhouse?
mhm. Yep, yep, absolutely, absolutely. Yeah, you just gotta kind of take a step back and look at everything from bird's eye view and be like, okay, well, is this gonna work? And then just kind of shrink it down, shrink it down, shrink it down. Okay, cool.
Yeah.
Let's move forward.
Yep.
Okay.
Yep. Exactly.
Yeah. So, but Nick, I really appreciate your time. Thank you so much for hopping on a call with me. It's
Yeah,
been great.
absolutely.
Yeah.
Have
Yeah.
a great one. Thank you for the interview, and we'll talk soon.
Absolutely. Thanks so much, Nick.